This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I'm your host. Very excited today. Another great guest. I have John Boik, who is a very well-known author in the investing and finance landscape. So he's written a whole bunch of books. I think it's 7. John, is it 7 books altogether?
It's 4.
4 books. Okay. 4 books. And the 3 most popular ones are Monster Stocks, which John said is his personal favorite. And then the other 2 are How Legendary Traders Make Millions, Lessons from the Greatest Stock Traders of All Time. And then I guess the 4th one, which I'll mention, is Monster Stock Lessons. You can actually see all 4 of these books on John's Twitter profile. They're in his header image, which is what I'm looking at right now. And then they're also available on Amazon. John, welcome to the show.
Hi, Jonah. Thanks for having me. It's a pleasure to be here.
You're welcome. So I'm excited about this. You have written a lot about the history of the market and the best traders and comparing current times to previous times. So, I mean, we'll try to unpack all of that. Where would you like to start?
Well, I just want to make every trader typically has, they do fundamental analysis, they do technical analysis, they do psychological analysis, and those are all absolutely critically important. But what I do is I add historical analysis to the picture, because I really believe that if you understand the history of the market, history of the greatest traders, how their strategies all kind of aligned in similar fashion, and then you understand how market cycles work, and then if you understand those things, and then how the best stocks over time have looked similar and all reacted in typical patterns that repeat themselves, I think you add such an important piece to your toolkit if you understand all that history of the market. And I've really condensed it down into those books. And I would just say, I'm a example of that. I think when I started, I didn't know anything. I was just taking tips from CNBC and watching that show and everything, and kind of ignored what the market was doing, the general market, and how cycles work, how some of the impacts from a macro perspective affect the market. Typically, there's only 3 or 4 that really matter. I mean, and we're seeing it today: interest rates, inflation, how the Fed acts, and all those things. And everything we're seeing today has been repeated in history before, several times over whatever decade it was. So I just think that if a trader is really going to do this in full time, I think understanding how historical market cycles work, how the best traders maneuvered in and out of those cycles over time. And my books and the study I've done go all the way back to 1888 and cover every single year of the market from 1888 to today. There was a great trader involved in the market at that time. And these traders all had similar strategies in how they reacted to the market, understood what it was doing, what some of the best stocks that they landed did. And these were the greatest traders of all time. So you can't argue with them. There's Jesse Livermore and Gerald Loeb and Bernard Baruch and Nicholas Darvas and William O'Neill. And we have some great modern day legendary traders today: Mark Minervini, Jim Ropel, David Ryan. All those guys studied all the ones I just mentioned before. And
what makes a great trader, do you think? Or what are they paying attention to the most? I mean, like you said, technicals matter, fundamentals matter, macro matters. Do you think they pay more attention to macro than we realize?
The commonalities of the greatest traders, I would say the first key is discipline. They are extremely disciplined. They learned that over time, and the more experience they got, the more disciplined they became. The more mistakes they made, the more disciplined they became. Discipline is the key to everything. So and you have to filter out all the noise that's out there. We've had a lot of noise in the last 4 or 5 days. Some of it was factual, some not, etc. They were disciplined to their rules. They created rules that kept them in the longevity of it. So a great trader to me is somebody who has a long track record. A lot of these guys were in the market for 50 years or more.
Wow.
And they didn't blow up. They made big mistakes the first 4, 5, 6 years of their career. Then they created trading rules that they stayed disciplined to. They didn't bend them or break them. And they had the patience to wait for the right opportunity. That's what makes a great trader. So creating rules that worked for them, sticking to them, and not bending or breaking them, and not making like impulsive trades all the time. I mean, today's another great example. We knew we'd have an update after all that damage. And there's a lot of things going on. So a lot of people will just jump right in. And there's still a lot of overhangs and all these other things. And patience is so critical to it. These traders waited for the right opportunity. It's kind of like
they call it like they're waiting for the fat pitch.
the fat pitch. I was just going to say that. That's a perfect example. They didn't swing at everything. So they had the patience and discipline to do that. Those were the keys. And then once you have
Sort of like Barry Bonds. I mean, remember Barry Bonds? He didn't mind taking walks, 4 times a day if he had to. He would wait for that fat pitch and then hit it into McCovey Cove or whatever it's called, right?
That's right. That's perfect example. So they all did this, and it didn't matter what era the market was in. I go back the early 1900s, and Richard Wyckoff was doing the same thing. He was one of the first pioneers of all of that to say, wait, let's just wait till the market confirms this uptrend type of wave that you want to be in. I'll bounce all over the place here just to give examples.
Oh, no. I mean, this is great. I mean, now, what are some examples of rules? I mean, we all know that you should have stop losses to prevent, to maximize or at least know what your downside risk is. Stop losses are not perfect. We all know that. I mean, things can gap down. They don't work pre-market after hours. So, that's just one rule that helps you sometimes, but not all of the time. Right. What are some other examples of rules that you found the best traders, what's a common rule among them?
Well, adding to what I said earlier, that the patience to wait for the right market environment. We're still in, if you look at the NASDAQ, we're still in a 16-month downtrend with these short market rally, bear market rallies up, and then resistance hits. And I mean, this last one looked a little better, and then we had this, but they would wait for the right opportunities. They would wait for stocks to set up in basing patterns, whatever they were. Darvas had the box theory.
Yep.
And Livermore had the resistance pivot point theory. And O'Neill has the patterns of the cup with handle and the double bottom and the saucer and the flat base. All three of those, this is 100 years of data of study. All three of those look the same. The patterns look the same. Every monster stock, I call that a monster stock that doubles in price within a year. Okay. Every single one over history looked exactly the same. Not exactly, but very similar to that. So they would wait for the right environment. A great example is 2020, after the March COVID, the bear market that was the shortest and fastest in history. From April 2020 through October 2020, many people had triple-digit years. I had a triple-digit year that year, and I did it all in 6 months.
Right, same here.
You waited for, and the leaders that came out of it. So back to your question, new leadership when an uptrend begins. Back then it was Zoom and DocuSign and Peloton and Etsy and all these other, there were a lot of them. In Monster Stock Lessons, the book that came out last year, I have 29 of those stocks that traded over 1 million shares a day on average. 29 of them rose over 100%.
Wow.
Many of them rose 300-400%.
Oh, for sure. Yep.
And they all looked the same. The patterns were similar. And if you waited for that and then got into those, And then they used the more modern guys that use the same type of strategies, use moving average lines or boundaries of, is this getting support? It's price and volume action with support. And the 2020, DocuSign and Peloton, they all bounced off their 21-day lines all the way up. They pull back on low volume, they take off on high volume. These are traders using those tactics to come in and out, taking some profits, pulling back, adding to it, pyramiding up. Pyramiding up on strong stocks is a strategy all those traders use. So that was a rule. So yeah, there's the loss cutting. When you know you're wrong, get out of it. When you know you're right, pile into it. Those were the strategies that all of them did that. Livermore did it. Bernard Baruch did it in 1910. Gerald Loeb did it in the 20s. Darvas did it in the 50s. Dreyfus did it. O'Neill did it in the 60s, 70s, 80s, 90s, and 2000s. The same strategies.
I mean, I must admit, being patient is very difficult. So how patient were they willing to be? How long were they willing to just sit on their hands, hold cash, and wait for that fat pitch?
Well, I'll tell you, most people who know Nicholas Darvas just read How I Made $2 Million in the Market. It's probably my second favorite book that helped turn me around. But he wrote another book in 1977 called You Can Still Make It in the Market. And he talks about the bear market of 73 and 74, which were brutal. He completely sat out those markets for 2 years.
Wow.
Didn't make one single trade. Jeez. 1975 comes along and the Fed's pulling back on interest rates and inflation's coming down a little bit. And the market starts coming up. He's watching the market every day. And he goes, I'm seeing some stocks make a little bit new highs and all these things. And he jumps in 75. He gets into Houston Oil, National Semiconductor, and Tandy. He makes triple digit gains on all three of those stocks within 6 to 9 months. So here's a guy who learned that in the late 50s when he made all that money and wrote that famous book. Here he is 20 years later, same strategy, being patient, staying out of the market, and then piling in when it makes a turn. And here's some leading stocks basing and in his box theory, bouncing around and then take off on big volume, and he piles into it. So that's just one example. So that's from the 70s. So then
what do you think those guys would be doing today with all the macro headwinds, the Fed, wars? I mean, you can go on and on. I mean, the list is pretty long of potential headwinds. Do you think they'd be sitting out right now?
Yes, I know that if you take everything that they did, and there's always going to be macro issues in the world.
Right.
That's just not going to have a perfect scenario ever. Okay. So if you look, so the second book, I'm not trying to promote the books here, but
no. I mean, I sort of want you to, because I think, that's where all the nuggets of information are. They're in the books.
Where all the history is. So in that book, every chapter is a decade of the market, 1900 to 1909, 1910 to 1919, and so on. And I talk about so Livermore and Baruch are in the first couple chapters, and then Gerald Loeb comes in, and then Wyckoff is there, and Dreyfus, and then Darvas. Every chapter I say, this is what the market is doing. This is what they did. They sat out, they waited. Like 2000 was a great, O'Neill kills it in those market periods. In 98 and 99, he had his two best years ever, up 400 and 300% each year.
Wow.
2000 comes around, March 2000, the leaders are topping, there's distribution coming in, everything's pulling down, the Fed's raising rates like crazy. And they called it, IBD said it, get out, sell your stocks. O'Neill was out of that market for the better part of 2 years. And then Jim Ropel, the same thing. He was out of those markets. And then in 2003, so in October of 2002, the market bottoms.
Yep.
And after a 2-year brutal bear market, you're going to have this chop along the bottom. It's not just going to go down and straight up. There's this chop. There's all that damage that's been done. In March of 03, the market starts to take off. and go over resistance areas that had been, and there's all these new leaders, all these new names that had basing and everything like that. O'Neill piles into eBay, had, from what I understand, 90% or more of his account, and he's got a big account, in eBay, and crushes it. Jim Ropel is in he's in at least 10 of those leaders in 03, and has one of his best years ever. But what did they do? They had the patience to wait. They waited out that bear market for 2 years. Frustrating as all get out, but they kept their capital. You keep your mental capital because you don't get destroyed, and you keep your financial capital. And they had, a war chest of cash to go in 03 and pile in, and that upturn was very strong. So that's what they did.
If they have the foresight to get out of the markets when things are getting bad, or there's no more setups, headwinds, whatever you want to call it, do they do any shorting? If they don't see any opportunities to be long, are they willing to go short, or they'd rather just sit on cash? Because I've heard Mark, Minoverti talk about this, and he really doesn't do any shorting. He makes his money on the long side.
Yeah, he says 99% of his gains have been on the long side. O'Neill, 90% or more on the long side. Ropel, same thing. Ropel will short the index, but it's very small.
Okay.
Livermore and Baruch and Wyckoff, this is in the 1900s, 1910. The markets were way more erratic back then. You had a lot more, from an economic standpoint, recessions were way more commonplace back then. They took advantage of those opportunities. But when you get to like Gerald Loeb, who was, to me, is one of the greatest traders ever, doesn't get a lot of publicity, which I don't know why. 1920 to 1970, one of the best traders ever, never shorted a stock. And he made money every single year in 1929, 1930, 1931, and 32, the worst bear market in history. He would jump in these short bear market rallies like we've seen, and just take fast positions. He was called a skittish trader. He kind of invented swing trading just about. But he didn't short stocks. Darvas never shorted stocks. O'Neill didn't. O'Neill shorted a little bit in the early part of his career, but later on, he made all that money on the long side.
Interesting. Okay.
So they said, look, the thing is, the market's going to reel you in. And it's the discipline and the patience and the rules. Me, I've tried shorting. I'm not good at it. I admit it. So I'm like, I'm not going to touch that. I don't want to, because I know the next upturn, I'm going to kill it. I know it, because I know how to. It took me forever to do that, but I know how to wait now, and just wait and watch. And then there's always going to be new names. And those are the ones that are to scream up. I have a big project I'm working on, and I'm going to announce that in a month or two, but I have all this. I've studied every downturn since 1900 and every upturn and every stock that was in each one, and they all looked similar. So these base patterns, these box theories from Darvas, these patterns that Livermore and Wyckoff discovered in 1900, they still stay the same. And as long as people are involved in the market, Livermore said it too. The pockets will change, the names will change, but the market's still going to do the same thing because humans are involved. And I know there's AI out there for some of those things, but they're still programmed by humans. And you see these same patterns. It happened in 2020. And then in 2020, 2021, all those leaders of the COVID rally, they all topped. I have those all in Monster Stock Lessons. They topped just like the stocks in 2000 topped. They topped just like the stocks in 1929 topped when that market topped. And so if you can see that happen and get out of that, which I did, and I know Ropel did, and Minervini did, and O'Neill did, and they all did the same thing, because the same pattern, that topping pattern, happened over and over again.
And they get out when they start to see the charts rolling over, distribution, moving averages failing, that sort of thing, right?
Absolutely. And here's the thing. the financials are going to be glowing and triple digit. It doesn't matter at that point. It doesn't matter. It happened in 29. Look at RCA in 1929. What a classic 500% move, tops. The financials are great. Everybody's got a TV and all that kind of stuff. And Loeb was out of that stock and Baruch was out of that stock and Livermore because it broke. The uptrend stopped. You can see it on a chart. And so they sell it. They're the ones causing the downtrend. Big traders like that. And then everybody's doing the same thing. Just like when they pile in and run them up, they're piling out and running them down.
So a couple of the more recent, let's call them legendary traders, Ropel and Minervini, which I'm familiar with both of them. Do they have their own style, or are they picking pieces from some of the, the more legendary, the older guys? Are they using the Darvas box theory? Are they using cup and handles and all that? Or are they coming up with their own strategies from scratch?
They're not coming up with their own strategies from scratch, but what they are doing is they're tweaking the commonalities that really were started by Richard Wyckoff and Jesse Livermore back in the 1890s. All of those stocks that are basing and breakthrough resistance points and move on increased volume and it's price action and volume. And then later on, you get to charting in the 30s and 40s and they create moving average lines. So and O'Neill took that. He was the first one to create the stock database. And then he moved all those moving averages back to 1900 and 1910. Guess what? Same thing. You can see them bounce off of those things.
So now,
back to your question, just real quick. So Minervini, yes, he's tweaked a lot of those things because he likes to buy sometimes in a base, that VCP pattern he calls, which is phenomenal. Ropel has tweaked a lot of what O'Neill does, but he sticks a lot to that. But you tweak it to your own personality because we're all different. We all have different makeups and all that other stuff. But the core strategies are still similar. Just like O'Neill took the Darvas box theories and still saw the same patterns. He just created these names for these patterns that he saw. But if you look at Darvas, I have some charts that show a stock, and in a box is the Darvas box theory, and in a circle is O'Neill's patterns. They are all on top of each other. So yes, they tweak it to your own personality. Like for me, I don't short stocks. Well, Livermore did. Minervini doesn't short, but Livermore did. And so did Baruch. So they're like, well, I'm not really good at that, or I'm not interested in it, or whatever it is. I'm not going to do that. But on the long side, yes, they're still following the same structure of the strategies. They're tweaking them to their own personality.
Now, in order to get a monster stock, which you said is a stock that doubles within 12 months, can stocks do that without a strong market behind them?
There's been some in the past. Taser is probably the greatest example. The market wasn't streaming ahead in 04 like that, but Taser was a master monster stock, and it did that. The majority of them will run with the market. O'Neill's proven that 75% of the stocks will follow the general market. There's always going to be some outliers.
Right. But like you get like a pharmaceutical company that gets an approval on a drug. That's
correct.
Right.
Yeah, correct. So, but if you want the odds on your side, again, these greatest traders, they would wait till the market was really in an, what do you want to call it? A confirmed uptrend where you can see it, you can feel it. Like right now, we can feel the last year, we've all felt this is a bear market. This is a downtrending market. I'm talking about the NASDAQ. The Dow kind of held up a lot better.
It still feels that way. It still feels like it's just a choppy market that doesn't know if it wants to go up 10% or down 10%.
Yeah. So a lot of those guys would wait it out. I saw a tweet by Minervini this morning. He said, I'm still in cash because there's still so much volatility. We're going to have these massive swing. Now it's like, is the banking system going to crash again? How many more are out there? And then So you got a decent CPI. I mean, if you call 6% decent, but the Fed probably will pause, whatever. Everybody's guessing now. So now you're having these huge swings like this. And unless you're a master scalp trader or a master swing trader, which is, that's not me again. I tried that, it didn't work. So it's like, well, I'm gonna, I have a couple positions that are working, so I'll stay in those, but it's pretty small. I mean, I'm gonna wait till this, we almost came out of it. We cleared a 200-day and a 50-day and all that other stuff, but there's still, if you look at the moving average lines, I said this before with IB, in great uptrends, the 200-day line is down here, then the 50, then the 21, then the 10. When you have stacked like that and you're an A+ market, stocks are ripping, and you will have your choice of how many monster stocks do you want to hold or
So that's my next question is the best traders, how many of these stocks do they typically hold at a time?
3 to 7. That's
Okay.
it. That's it. And O'Neill, so 1990, 91, that market was in an uptrend. He was in Amgen and had nearly his whole account in that.
Jesus. So he's not afraid of concentration.
Well, he knows the stock well. He does his homework, and he had a 550% gain on that stock.
Wow.
And when you have almost your whole account in there, you're going to kill it. So in 02, the end of 02, at the bottom of that bear market, and in 03, he piles into eBay, and by that time he's got a massive account, massive money in his account, and he piles into that stock with almost everything he's got because he's watching it closely, and he's like, this is, Jim Ropel says this all the time. He goes, I've never, and so does Mike Webster, I've never met anybody in history that in an uptrend, that guy has the top 2 or 3 leading stocks. That's all he wants. I want the best stock, the leader, and he always seemed to get it. Why? Because he did all his history. He studied Loeb, he studied Dreyfus, he studied Livermore. That's where he built his strategies from. And he studied every pattern of the greatest stocks in history going back to 1880. And he's got them laid out, and he knows what to look for.
And these guys they're all
when an
position
uptrend comes,
traders,
he's going
right?
to hit it. He's going to hit it.
These guys are all position traders. When they're getting into a trade, when they think they see their fat pitch, they're getting in with the intention of holding for 6 to 12 months or longer.
Well, if that's the intention, if the market works with them,
Right.
But if it doesn't, they cut the loss quick and they're out. And they go, well, that one didn't work.
Right. Right.
And so Ropel will say this. I don't know what Minervini's is. He's like a 50% win-loss rate. Okay. When I was writing monster stocks, I sent all my edits to O'Neill because he had to approve them all. And I put in there, I said, I think he has an average win-loss rate of like 66%, which is unheard of. And I'm crossing my fingers, hoping that when he comes back with the edit, and he left it. So he's like, yeah, you hit it, John. That's about right. And I was like, wow, that's incredible. I mean, to do that, so he's still wrong that many times, right? So 34%, he's still wrong. But the times that they're wrong, they cut the loss. That's the risk management side.
And what do you think his typical loss is? 5 to 10%?
3 to 5.
Wow. Okay.
I would say this, when he met Gerald Loeb in 1970, he asked Loeb, he said, do you really cut your loss at 10%? This is O'Neill talking to Loeb at O'Neill's office. And Loeb turned around and said to him, I'm out well before 10%. That was Loeb. He was a short loss cutter.
Okay.
So O'Neill says in his books too, he goes, I advocate cutting a loss at 7 to 8, but I know he cut them at 3 to 5 because I put it in the book and he approved it.
So even though he's, his win loss is 66%, so he's losing a third of the time, he's only losing, when he loses, it's only 5. And when he wins, it's probably 20, 30, 40% or more.
Minimum.
Right.
So when you're hitting big leaders and you're scoring triple digit gains on them, do the math. I mean, it's incredible.
I mean, we all want to find stocks that go up 100% in 12 months. I've had a bunch of them in the last couple of years, from Upstart to Celsius to, all the cloud stocks that you mentioned, the Pelotons, the Zooms, the CrowdStrikes, the Cloudflares, all of them. Now we're in a different market and we have to try to find the next group of leaders. Once we're back in a bull market, I don't know if that's going to be next month or next year. How do we try to find the next group of leaders that can triple for us in 6 to 12 months? Is there any, do we look at the stocks that are currently basing? Do we look at the stocks that, like right now, my thing is I'm looking at the companies that recently reported Q4 earnings, gapped up, gave great guidance, because I feel like those are the stocks that once we get into a healthier market, those are the ones that have a chance to re-rate higher. So that's my focus list. But I'd love to know what you think and what some of these other great traders do to try to find those next leaders.
Well, again, they all did the same thing in bear markets. They're looking for stocks that are resisting the downtrend the most and have the strong financials, of course. And they're looking for watching the supply and the demand of what traders are doing with those stocks. So, I mean, right now, there's several that look very attractive. So they're holding up. My favorite one right now is just, I'm watching the market here, made a brand new all-time new high this morning, and it's holding. So those are the ones showing power in this downtrend that tried to get out in January and early February and then been slapped down again. And if we can tame the Fed and inflation, I think there's your key right there. Historically, that has been what has moved a market higher. And there's handfuls of stocks right now that look really attractive in this kind of, not so great market. So those are typically, historically, those are the ones that are going to lead the next uptrend if it comes. It will come. It's just a question of.
Oh yeah, it always comes. It's just a matter of when. Do the best traders do anything with small caps and mid caps, or they focus mostly on the large caps because they want the liquidity?
Well, I think it depends on how big you're. Like Ropel, who's managing money with a hedge fund, he wants liquidity, so he wants bigger cap stocks. But there's still names that are liquid that probably aren't well known right now, but they're still showing really good action. So, I mean, just again, my personal preference, I like stocks that trade at least 1 million shares a day because I want some liquidity in there. I don't want some stock that's trading 80,000 shares or 100,000 shares a day because they can move pretty wildly. And the ones that are trading 1 million, or let's say 500,000 to 1 million at least a day, you've got some eyes looking at that some money managers have an interest in. They're managing money, so they're going to take bigger positions. They might hold them longer because they're more position traders or whatever they're going to do. So they're not buying cheap stocks. They're not buying penny stocks. They're not buying, all the junk in the bottom of the barrel type of thing. So
do the best traders ever use ETFs, or is it strictly individual stocks?
All of these have made their big money on individual names. They concentrate them 3 to 5, maybe 7 stocks, and but you have to make sure you're in the leader, like O'Neill did, like Ropel does, Minervini does. All these, David Ryan, they all do the same thing, and they're all very successful. And they're, again, I hate to sound like a broken record, but they're doing the same thing. When Darvas killed it in 58, 59, he was in 4 or 5 names, but he was in all the big ones. Fairchild Camera, Texas Instruments, Universal Controls, Theocal Chemical. Those were the leaders of the day. They were killing it financially, and they were the leading stocks. And he was in all of them at the same time and just piled into it.
Do the best traders ever use margin? Do they use
Yes.
leverage?
Oh, absolutely.
Okay.
When you're right and you know it, that's when you hit the gas. And Ropel can go 150% in when he's right, and he knows it. He killed it on Broadcom in 2000. He was 200% margin in that one stock.
Wow. I mean,
But
like
he
you said,
made-
I mean, if you're waiting for your fat pitch and you get it, right, go as hard as you can.
Go as hard as you can. That's the difference. I mean, and here's the thing. These guys are not one-hit wonders. So many people in history have done that before. You know, I made $1 million on this, and then they blow up and they're gone.
Right.
These guys, so Ropel, Minervini, David Ryan, these guys have been in the market for now 30 to 40 years. They're still there. Dreyfus was in the market for 60 years, O'Neill 50 years, Loeb 50 years, Livermore 45 years. And the longevity is key. And they didn't bend or break their rules and become, well, I'll say, so now I'm in a bear market, I'm going to try to be a value investor. They didn't do that. Instead, they just waited for their time. I created these rules, they're historically proven. That's what I'm going to wait for. And I'll wait as long as it takes. Like I saw somebody ask Minervini a week or so, how long are you going to wait? He said, as long as it takes. What's the difference? Why would I subject my capital to higher risk when I know I'm really good at this one thing that's made me who I am, and I'm extremely disciplined in it, and I know how to do it? Ropel says the same thing. He's got a weekly podcast that's really, really good. And he's been saying stay in cash. He's been saying that for months and back to last year. And he's like, I'll take a pilot position on some of these rallies. If it doesn't work, I'm gone. But if it does work, I'm going to hit it big. And I know there's the next bull is right around the corner. And the best bull markets in history come after pretty hard corrections or bear markets.
So that's sort of what I'm wondering is, can we actually get into a meaningful bull market until we really, really correct here and get, because after the dot-com bubble, after the great financial crisis, I mean, stocks got absolutely pummeled down 50, 60%. I mean, the indexes were down 50, 60% to where valuations were dirt cheap. Even though we've had some corrections, you can't say that right now. I mean, valuations at 18 times or 18 and a half times earnings are way more expensive than they were after the dot-com bubble and after GFC. So I'm just wondering if we can really, are we just going to keep chopping along for the next 2 years, or do we really need a big correction in order for traders to find that fat pitch?
You go back in history again, the overhangs on the market right now are twofold. It's inflation and rising interest rates. And the impact of the rising interest rates, pretty much, I don't know why, but it caught a lot of people off guard last week because now banks had invested long-term and they're upside down. The yield curve's inverted. Historically, that's always told you there's a recession around the corner. So you have all these things. You have historically high inflation and the Fed being more aggressive than almost ever in history. If those things will stop at a certain point, when will it be? Next month, 6 months, a year, whatever it's going to be. Once those are cleared out, historically, the market can move. But it doesn't have to get so bad. I think that's what people are still waiting for. I put this thing on Twitter a couple of days ago. 1994, in late 93 through 1994, the Fed raised interest rates 7 times in a row in 1 year.
Sounds familiar.
Right. Inflate, because they were concerned about inflation. It wasn't as high as it is here, but it was still a problem. 7 times in a row in 12 months. We've done 8. Okay, so it's almost the same. 1994, the market pulled back every time they raised the rates, and then it chopped along, but it didn't implode. The Dow was down about 10%, the Nasdaq was about up 12 or something like that. And then in 95, they reversed course. They paused and then they reversed course, and the market screamed out. So just because they do that, everybody's kind of waiting. When is this thing going to crash to the ground? The economy really still doesn't look that bad.
No, it's still in pretty good shape. I mean, everyone that wants a job has a job.
There's jobs available. But if we can tame the Fed and interest rate, and it looks like it's coming down a bit or whatever, but historically, again, the Fed is always late to the game. They were late this time. You can't just print trillions of dollars in 2020.
And they always I mean, they go too far both directions. They go too low for too long, then they go too high for too long, and they hike until something breaks, and now we broke something.
That's right. That's exactly. And once again, this is just history repeating itself over and over and over again. We never learn the lessons.
So what's your process for finding, because you said there's a couple stocks that are on your radar right now that are holding up. So that means you're focused right now on relative strength. That's one of them.
I look at relative strength, but I'm really looking at supply and demand in the stock and is it okay, so ANET's my go-to right now.
Okay. Yep.
It's been out there for months. It kind of chopped back, but it never broke hard. And today it's making a all-time new high on volume in a kind of a suspect market. The financials look great, and that thing is moving. Somebody's buying that thing. If you look past the last 3 to 6 months, the price and volume action on that thing, it's very positive. That catches my eye. So I'm like, I like that thing. I've been in it for, I didn't even pull back last week because it never broke anything. So that's one. I like ALGM is.
Yep.
That thing is, it hasn't broke anything. It's holding the 21-day even after all that stuff last week. And that's got a great business model. They have these microsystems in the auto industry and everything else that's kind of like the future here. So those names look good. They're liquid and they're holding, and there's supply and demand in there from price and volume action, and they're holding key moving averages, and the financials are phenomenal. And those are the same characteristics of the best ones in history. So I don't know if they break, I'll be out of them. I'm not married to them, but they look good. There's a bunch of others that it's hard in this market to say, wow, there's some good stuff out there, but there is, Mobileye looks pretty good. It came back down to the 50. Looks like it's getting support there. It's got a great.
Is that good or bad in the eyes of a great trader, the guys that you've studied? Is it all right if a stock pulls back to the 50-day?
A lot of, like O'Neill, he would pray for that because he would say, I really want more of this, but I'm not going to buy it too extended. So I'm going to hold my basic as my core position on it. And if it drifts back to the 50 on lighter volume and then even falls under it and all this and doesn't stay under there for too long, maybe a week, and the volume, and then it comes back up off of it like a spike volume off of that, he'll buy into that.
Okay.
He loved that. So now he's like, now I'm getting back into it. Price Company that he owned in the 80s. He bought that stock 285 different times over 7 years. 285 times he still owned the core position. He owned 4.99% of the stock because if you owned 5%, you had to register. He never went across that line.
I mean, I thought I had conviction on names. I mean, that takes conviction to a whole new level. He should, next to conviction in the dictionary should be his face.
So imagine that 285 buys over 7 years, ran it up the whole time. When it pulled back, he bought more and bought more, bought all the way up. And then he finally sold the whole position and he took the money from that and funded IBD.
Wow.
So, there you go.
Folks. Okay. Love that. We'll end there. Well, John, thank you so much, man. I really appreciate it. Glad we got a chance to do this.
Okay.
Congrats on all the success with the books. This new project that you're talking about, is this a new book or something different?
It's not a book.
Okay.
It should be interesting to see. So
cool. Keep me posted.
Okay. All right. Well, thanks for having me. I really enjoyed it.
Absolutely. Let's do this again when we're back in a bull market.
Sure. No problem. Thanks again. Have a great one. All right.
Bye.